When Elon Musk makes a move, the world watches. That has been the rhythm of Tesla's story for more than a decade, and once again, headlines lit up when Musk personally purchased nearly $1 billion worth of Tesla stock. What makes this action stand out is not only the size of the purchase, but also its timing. This is Musk's first major buy since February 2020, more than 4 years ago. For a man whose reputation is tightly interwoven with Tesla's rise and turbulence, every financial gesture sends a signal to Wall Street, to investors, and to Tesla's competitors worldwide. Why does this matter right now? To answer that, we need to look at Tesla's environment in 2025. Over the last year, Tesla's stock has faced heavy volatility. The company remains the world's most valuable automaker by market capitalization, but its path is no longer unchallenged. Rivals like BYD in China are aggressively expanding with budget-friendly EVs, while legacy automakers such as Toyota and Volkswagen are doubling down on electrification strategies. In this climate, Musk's personal buy acts like a flare in the night sky. It suggests confidence, conviction, and perhaps even insider knowledge of where the company is heading next. There is also the psychological effect. Tesla is not just another car company, it is a brand powered by narrative. Investors often say, if Musk buys, maybe I should too. His personal actions resonate because he is not only Tesla's CEO, but also its chief storyteller. Remember the last time Musk bought shares in early 2020? That came just before Tesla's historic rally that transformed it into a trillion-dollar company. Could history repeat itself, or is the situation fundamentally different now? Alongside this stock-buying headline is another less glamorous but equally critical piece of news. Tesla vehicle registrations in China have slowed. According to weekly data from the China Passenger Car Association, CPCA, Tesla's registrations were down roughly 7% year-over-year. There was a slight bump in the past week thanks to demand for the Model Y and the refreshed Model 3, but overall, momentum has weakened. For a company that has long relied on China as its largest overseas market, this trend is impossible to ignore. So, here we are, two contrasting signals arriving almost simultaneously. On one hand, Musk is doubling down on Tesla stock with his own money, a move that suggests optimism. On the other, Tesla's most important growth engine, China, appears to be losing steam. What does that mean for Tesla's future? Is Musk betting against the tide, or does he see an opportunity that others don't? To understand this moment, we need to explore both sides of the story. First, we must break down the numbers. How large Musk's buy really is, how it compares to the past, and what analysts are saying. Then, we'll zoom in on the Chinese market, the registration slowdown. Tesla's position against domestic rivals like BYD and NIO, and why this matters not only to Tesla, but to the entire global EV industry. Finally, we'll connect the dots because in Tesla's world, financial signals, market dynamics, and Musk's larger-than-life narrative always intertwine. The stakes are enormous. Tesla is not simply navigating quarterly earnings, it is balancing the future of electrification, artificial intelligence, and even robotics. Musk has often said that Tesla's most valuable product may one day be its Optimus humanoid robot rather than its cars. Yet, for now, the company's lifeblood remains vehicles, and China remains its heartbeat. That's why the current mix of confidence and caution makes this moment one of the most fascinating junctures in Tesla's history. When Elon Musk steps into the stock market with his own money, it rarely goes unnoticed. This time, the scale is striking close to $1 billion worth of Tesla stock, his first substantial buy since February 2020. That fact alone carries weight. Back in 2020, when Musk last made such a personal move, Tesla was on the verge of the meteoric rise that would see it become one of the world's most valuable companies. Investors remember this. Markets remember this. And because Musk is not just the chief executive, but the very face of Tesla. His decision to commit that much capital sends an unmistakable message of confidence. According to coverage from Reuters and investors, the purchase was executed over several days, consolidating Musk's position as Tesla's largest shareholder. In a financial landscape where timing is everything, this decision could be interpreted in several ways, either as a bold bet that Tesla shares are undervalued, or as a statement to reassure jittery markets that the man leading the company still believes deeply in its trajectory. Context, however, is crucial. Tesla's stock has endured significant volatility over the past year. While still commanding a valuation that rivals or exceeds most of its automotive peers, combined, the share price has lagged behind broader indexes, such as the S&P 500. Analysts have noted that Tesla's market capitalization is no longer untouchable, and its dominance has been challenged by both the macroeconomic slowdown in global EV demand and the aggressive rise of competitors, especially in China. Against this backdrop, Musk's billion-dollar purchase is not merely a personal investment, it acts almost like a strategic signal flare. It tells shareholders that he is prepared to put his own wealth on the line at a moment when sentiment is fragile. But the optimism of that signal collides with a more sobering set of numbers from Tesla's most important market outside the United States. Weekly vehicle registration data from the China Passenger Car Association shows that Tesla's registrations have slowed. On the surface, the picture is mixed. In the most recent week, there was a modest uptick driven by stronger demand for the Model Y and the refreshed Model 3, a sign that Chinese customers still recognize value in Tesla's core offerings. Yet when measured year over year, registrations are down about 7%. That decline may not seem catastrophic at first glance, but in the context of China's electric vehicle industry, where growth has been relentless and new entrants appear every quarter, it is a worrying indicator. Tesla has long treated China as its growth engine, building a massive gigafactory in Shanghai and tailoring products like the Model Y specifically to local tastes. If that engine begins to sputter, the entire global growth story becomes more complicated. The registration slowdown is especially striking when compared to the performance of domestic Chinese rivals. BYD, for instance, has surged ahead with a strategy focused on affordability. Models like the Seagull and Dolphin, priced well below Tesla's entry-level offerings, are winning over millions of cost-conscious consumers. Meanwhile, NIO and Xpeng, though smaller, are carving out loyal bases in the premium and tech-savvy segments where features like battery swapping and autonomous driving packages resonate strongly. By contrast, Tesla's lineup in China remains relatively narrow. The Model 3 and Model Y continue to anchor sales, but without a truly low-cost vehicle in its portfolio. Tesla is vulnerable to losing share in the volume-driven part of the market. Registration figures reflect this reality, while the Model Y has kept Tesla in the conversation as a top-selling SUV. The broader growth of China's EV sector has outpaced Tesla's own momentum. Analysts are split on what to make of these conflicting signals. Bulls argue that Musk's billion-dollar buy should not be underestimated. In their view, Musk knows Tesla's internal roadmap better than anyone else, and such a substantial commitment suggests he sees catalysts ahead, whether in the form of the upcoming Redwood low-cost vehicle, further breakthroughs in battery technology, or progress on Tesla's autonomous driving ambitions. For them, the dip in Chinese registrations is a temporary wobble, likely to be corrected as refreshed models gain traction and as Tesla leverages its brand prestige. Bears, on the other hand, caution that the weakness in China reflects deeper structural challenges. Price cuts and cosmetic refreshes may boost short-term demand, but they are unlikely to change the fundamental issue. Tesla is competing in a hyper-competitive market against rivals who can produce at lower costs and appeal to the middle-class majority. From this perspective, Musk's stock purchase may be more symbolic than predictive, designed to restore confidence rather than to foreshadow an imminent rebound. There is also a middle ground, and it acknowledges the duality of Tesla's position. Short-term pain is real registrations down competition, intensifying growth slowing, but long-term potential remains vast. Tesla still commands unmatched brand recognition in the EV sector. It still produces vehicles with industry-leading efficiency and software integration. And it still sits at the frontier of multiple transformative bets. The fully autonomous robotaxi network. Musk has promised the humanoid Optimus robot that could redefine Tesla's business model, and new energy products that integrate solar storage and EVs into a seamless ecosystem. In that context, Musk's personal stock purchase may be less about the next quarter and more about the next decade. If investors are willing to look beyond the immediate registration data in China, they may interpret his move as aligning with Tesla's long-term disruptive vision. Ultimately, the data from both Musk's wallet and the Chinese registration logs tell a story of tension. On one side is conviction expressed in hard dollars by the man who knows Tesla best. On the other is caution reflected in the slowdown of actual cars reaching customers in the most critical market for electric vehicles. For the investor, the fan, or the skeptic watching Tesla, the question becomes, which set of numbers carries more weight? Is the billionaire's billion-dollar bet a glimpse of what lies ahead, or are the falling registrations in China the truer indicator of Tesla's current reality? The only certainty is that both matter and both will shape Tesla's journey in the months to come. To understand Tesla's current position, we need to place it against the backdrop of its fiercest rivals, especially in China, the world's largest electric vehicle market. China is not simply another arena, it is the ultimate proving ground for EV makers, where volume, price, and innovation collide in ways unlike any other region. In this environment, Tesla faces a paradox. It remains one of the most recognizable brands in the world, yet its growth is being tested by competitors who have mastered the art of scaling affordability. Take BYD, for example, the undisputed champion of China's EV industry. While Tesla focuses on the Model 3 and Model Y vehicles, positioned in the mid to premium segments, BYD has flooded the market with a spectrum of choices from budget-friendly hatchbacks like the Seagull to more upscale sedans and SUVs. The Seagull, which costs less than a quarter of a new Model 3, has become a phenomenon among younger drivers and families seeking their first EV. It may not match Tesla in raw performance or software sophistication, but its appeal lies in accessibility. The sheer volume of Seagull sales demonstrates how BD has cracked the code of mass adoption in a price-sensitive market. Compared with Tesla's 7% dip in registrations year over year, BD continues to post double-digit gains, highlighting the gap between Tesla's brand-driven strategy and BYD's affordability-first approach. Then, there are Tesla's fellow premium challengers, NIO and XPeng. Though smaller in volume than either Tesla or BYD, both companies are innovating in niches that resonate deeply with Chinese consumers. NIO has championed battery-swapping technology, allowing drivers to exchange a depleted pack for a fully charged one in minutes. This addresses one of the most persistent pain points in EV adoption: charging convenience. XPeng, meanwhile, has built a reputation for advanced driver assistance features and cutting-edge cockpit software, aiming to position itself as the tech-savvy alternative to Tesla. For Chinese buyers who value localized innovation and customer service tailored to domestic habits, these brands offer something Tesla does not: a sense of being built for China by China. Tesla's strength, however, should not be underestimated. The Model Y remains one of the best-selling SUVs globally, including in China, and the recent refresh of the Model 3 has reinvigorated interest among urban professionals. Tesla also maintains a powerful ecosystem advantage. Its supercharger network, though increasingly challenged by third-party infrastructure, still sets a benchmark for reliability. Its software, including the ever-evolving full self-driving package, positions Tesla as more than just an automaker. It is seen as a tech company with ambitions stretching into autonomy and AI. For many Chinese consumers, driving a Tesla is as much about signaling status and forward-thinking identity as it is about transportation. That intangible brand equity remains a moat that local rivals, despite their advances, struggle to replicate. Yet the weaknesses are equally visible. Tesla's narrow product lineup leaves it exposed to market shifts. While BYD can hedge by offering vehicles at multiple price points, Tesla relies heavily on just two core models in China. The absence of a true entry-level vehicle, a Redwood or $25,000 Tesla that has long been rumored, means the company is effectively surrendering the mass-market battlefield to BYD and others. Moreover, Tesla's pricing strategy, which has included aggressive cuts over the past 2 years, can only go so far before it begins to erode margins. Competing on price in China is like playing with fire. Local rivals can almost always go lower thanks to supply chain efficiencies and government support. Comparing Tesla's registration trends with the broader Chinese EV market illustrates this challenge starkly. While Tesla saw registrations fall 7% year over year, the overall EV market in China continued to grow, albeit at a slower pace than in previous years. This means Tesla is not simply a victim of industry-wide cooling. It is losing share within a growing pie. For a company that has positioned itself as a leader of the EV revolution, that reality is jarring. It suggests that unless Tesla can broaden its product mix or introduce compelling new models, it risks being outpaced in the very market that once symbolized its global expansion. The implications extend far beyond China. Tesla's performance in this market shapes investor sentiment globally. Strong numbers from Shanghai reassure Wall Street. Weak numbers sow doubt. Furthermore, strategies developed in China often ripple outward. BYD's success with low-cost EVs is not confined to domestic roads. It is beginning to export aggressively to Europe, Latin America, and Southeast Asia. Tesla, by contrast, has struggled to crack the truly affordable segment, meaning that in many of these new battlegrounds, it could be outflanked before even establishing a foothold. That said, Tesla's global strengths still give it levers to pull. In the United States, the company benefits from a strong charging network, government incentives, and a loyal customer base. In Europe, despite rising competition, the Model Y continues to dominate sales charts. These successes buy Tesla time. The critical question is whether Musk and his team can use that time wisely, whether they can accelerate the long-promised affordable Tesla, whether they can localize better for China, and whether their bets on autonomy and robotics can begin to show tangible results. In the end, the comparison between Tesla and its competitors highlights a dual truth. Tesla remains unmatched in brand power, global influence, and technological ambition. But in the trenches of China's EV market, where every week brings new launches and every month shifts market share, the company's vulnerabilities are plain to see. The 7% drop in registrations may not spell doom, but it is a warning sign, a reminder that even giants must adapt when challengers are multiplying all around. For Tesla, adaptation could mean the difference between holding its crown as the world's EV leader or ceding ground to rivals who understand the mass market better. And so the stage is set. Tesla's story in China is no longer one of simple triumph. It is a contest fought on price, innovation, and perception. Whether Musk's billion-dollar vote of confidence is enough to counterbalance the momentum of BYD and NIO and XPeng remains to be seen. What is clear is that the outcome will reverberate far beyond China, shaping the trajectory of Tesla's global narrative for years to come. Elon Musk has never been just another CEO. He is part engineer, part showman, part gambler, and part prophet. That mix has fueled Tesla's rise from a scrappy Silicon Valley startup into a company that reshaped the auto industry. Every bold prediction, every eyebrow-raising tweet, and every sudden decision has become part of the Tesla legend. And so, when Musk quietly moved to buy nearly $1 billion of Tesla stock, people didn't just see a financial transaction. They saw a story unfolding. Think about the timing. This is his largest personal purchase of Tesla shares since February 2020. Back then, the world was reeling from the early days of the pandemic, and Tesla's future looked uncertain. Yet Musk doubled down, and the result was historic. Within a year, Tesla's valuation skyrocketed, turning it into a trillion-dollar company and cementing Musk as the wealthiest man alive. Investors who followed him at that moment were richly rewarded. Now in 2025, Musk is back at the table, chips stacked high, making another bet. Is it a replay of 2020, or is it something different? Musk himself has often framed Tesla's story as one of long-term vision rather than quarterly metrics. He has told audiences that Tesla will one day be valued less for its cars and more for its robots and artificial intelligence. At one event, he famously declared that the humanoid robot Optimus could account for 80% of Tesla's future value. That kind of statement sounds outrageous until you remember that he once said Tesla would mass-produce electric cars profitably, and many laughed at the idea. Today, the streets are full of Model 3s and Model Ys. Perhaps when Musk buys $1 billion worth of stock, it is not because of this quarter's sales figures in China, but because he sees the seeds of something transformative. But stories cut both ways. For every tale of Musk, the visionary, there is the counter-narrative of Musk, the gambler. Critics point out that Tesla's vehicle registrations in China, its largest overseas market, are down about 7% year-over-year. The Model Y and refreshed Model 3 gave sales a small boost last week, but the trend is worrying. If China falters, Tesla falters. No matter how compelling the robot dreams are, the company's lifeblood today is still. Cars and fewer registrations in China mean fewer cars on the road. So what do we make of Musk's billion-dollar buy? Is it a genuine vote of confidence or a carefully staged signal to reassure Wall Street that Tesla is not losing momentum? History offers us a few clues. Musk has always been willing to stake his personal wealth on Tesla's survival. In the darkest days of 2008, when Tesla was weeks away from bankruptcy, he poured his remaining cash into the company's payroll. Friends told him it was madness. He shrugged and said he couldn't let Tesla die. That gamble kept the company alive long enough for the Model S to arrive, and the rest is history. Musk buying stock in 2025 may not be as dramatic as saving Tesla from collapse, but the echoes are there. He has always believed that when leadership shows faith with its own money, others will follow. And yet the circumstances now are more complex than ever. Back in 2008, Tesla's competition was skeptical investors and entrenched automakers who dismissed EVs. In 2020, the challenge was convincing the world that Tesla could scale. In 2025, the challenge is different. Tesla faces rivals who have already scaled. BYD is selling millions of vehicles at lower prices. NIO and XPeng are winning hearts with local innovation. In this climate, Musk's personal buy feels less like a simple gesture of optimism and more like a gauntlet thrown down, a reminder to the world that he is not finished, that Tesla is still his greatest bet. For investors and fans, the narrative becomes a kind of Rorschach test. Do you see Musk as the visionary who knows Tesla's next big breakthrough before anyone else, using his own billions to quietly accumulate before the storm? Or do you see Musk as the showman painting over cracks in Tesla's armor with bold gestures designed to keep the faithful inspired? Perhaps both are true at once. That tension is exactly what makes the Tesla story so captivating. This isn't just about registrations or market share. It's about a larger-than-life figure who has consistently turned impossible odds into reality, yet now faces perhaps his most formidable set of obstacles. The Chinese market is cooling. Competition is intensifying. Investors are restless. And in the middle of it all, Elon Musk makes his move, betting not with words, but with money. One cannot ignore the symbolism. To buy back Tesla stock at a moment when registrations in China are slipping is to say, I believe in this company beyond the present moment. It is the kind of act that either precedes vindication or becomes another chapter in the legend of bold risks that didn't pay off. And that is the story arc that captivates audiences. Tesla has never been a boring company, and Musk has never been a cautious protagonist. So here we are watching another chapter unfold. The visionary who once told us that a humanoid robot could define Tesla's future is now making his biggest personal financial bet in 5 years. The market data tells us one story: China is slowing. Musk's actions tell us another: Tesla's best days may still lie ahead. Which story is true? Which narrative will dominate? In the world of Tesla, the only certainty is that the drama never ends, and the stakes never stop rising. As we bring these threads together, a picture emerges of a company at a crossroads. On one side stands Elon Musk, placing a billion-dollar wager on Tesla's future, an unmistakable sign of conviction from the man whose identity is inseparable from the company itself. On the other side lie the hard numbers from China, Tesla's most crucial international market, where registrations have slipped by 7% year over year, despite recent momentum from the refreshed Model 3 and the ever-popular Model Y. This juxtaposition, unshakable confidence from the top and undeniable pressure from the ground, captures the paradox of Tesla in 2025. Tesla has always thrived on paradox. It is at once a car maker and a technology company, a mass manufacturer and a luxury brand, a financial roller coaster and a cultural icon. That duality is what keeps investors, fans, and critics glued to every development. Musk's personal buy injects a wave of optimism into the narrative, reminding the world of past moments when his audacious faith foreshadowed Tesla's greatest surges. Yet, the slowdown in China is not an abstract problem. It is a warning flare that the competition has grown sharper, that affordability matters more than ever, and that Tesla cannot simply coast on brand prestige if it wishes to dominate the next decade. Looking ahead, the questions multiply. Will Tesla finally unveil the long-awaited affordable model, sometimes referred to as the Redwood, that could bring the brand within reach of millions more customers worldwide? Will the refreshed Model 3 and the enduring appeal of the Model Y be enough to stabilize Chinese sales in the short term? Or will rivals like BYD continue to erode? Tesla's share, by mastering the lower-cost segment, beyond vehicles, will Musk's bolder promises, the robotaxi network, full self-driving breakthroughs, even the humanoid Optimus robot, begin to materialize in ways that justify his billion-dollar confidence? None of these questions have clear answers today, but perhaps that uncertainty is exactly what makes Tesla such a captivating story. Every twist and turn feels like a high-stakes gamble because in many ways it is. The world is not just watching a company balance supply and demand, it is watching a cultural force wrestle with its future. For now, the message is clear. Tesla's road ahead will not be smooth, but it is far from over. Musk's personal investment is a reminder that he sees the long game, even when the short-term picture looks cloudy. The registration slowdown in China, meanwhile, is a reminder that no brand, no matter how powerful, can escape the realities of competition. Together, these signals invite us to pay closer attention, because the outcome will shape not only Tesla's destiny, but also the trajectory of the entire electric vehicle industry. And this is where you come in. Do you believe Musk's billion-dollar buy is a genuine sign that Tesla is undervalued and ready for another rally? Or do you think the warning signs from China tell the truer story, that Tesla is entering a phase where growth will be harder to come by? Could both be true at once? We want to hear your perspective. Share your thoughts in the comments, because this is not just Tesla's journey, it is a global conversation about the future of technology, energy, and transportation. If you enjoyed this analysis and want to stay on top of the latest Tesla news, from financial moves to product launches and market trends, don't forget to hit that subscribe button and ring the notification bell. Every week, we bring you fresh insights that cut through the noise and keep you informed about the stories that matter most. Tesla's future is unfolding in real time, and you won't want to miss a moment.